you on getting confirmed as the market opens out today. Well, let's move ahead and take this conversation to Manishi Raychaudhuri, Asian Equity Strategist at BNP Paribas. Manishi, always great to have you on the show. Thank you for joining in. And I think the question that everyone's grappling with is that whether we've heard enough of the interest rate hike, yield inversion talk, and whether equities in India and around the world can really move on and price all of that in. What are your thoughts? We're still awaiting the jobs report, obviously, on Friday from the US. Where do things stand for you as you see them?
Since late January, there's been a profound shift in the market's expectation about where the Fed would go and how long it would stay there. And I think the jury is still out on this question. As you rightly pointed out, the jobs report on Friday, and subsequently the next week we have the CPI report coming out of the US. These would play a key part in influencing that expectation before the actual event on 22nd and 23rd March. Now, having said this, it now seems clear that we are in for a higher for longer world. In fact, possibly much higher for much longer, as it seems now. Our own expectation from the BNP Paribas economists have gone up to about 5.75% as far as the terminal Fed rate is concerned. And we think that would be reached sometime in the early second half, around July, August. And it would stay there till at least the first quarter of 2024. If one looks at the market's expectation from the US bond market, even about 5 weeks ago, the peak rate that the market was expecting was about 4.9%. If we look at the rate about 1 week ago, that rate expectation was 5.5%, and it's possibly around 5.7 to 5.75 now. So it's been a continuous and consistent increase in the rate expectations, the tighter monetary policy expectations. And I think the market has now, coming to terms with this expectation that the Fed would actually raise somewhere around 5.75 to 6 and possibly stay there till the end of this year. And this change has been rapid. It's been remarkable, literally over the past 5 weeks or so. And I think there's a reflection of that in the valuations. There's a reflection of that in the flows that come into the emerging market economies. We saw that in February, even though March has been slightly better for some markets. But this...
Sure. Okay, I think there's some issue with the video, Manishi. We'll try and get back to you in a bit. For now, the market is very quiet, really, just consolidating. The Sensex is down about 100-odd points. It's the Adani Group stocks that have made a big comeback. So Adani Green, Adani Total Gas Transmission, Adani Power, all up in the green, up about 5% today. And this month so far, some of these stocks like Adani Green, Total Gas are all up about 30-40%. Manishi, good morning. So what do you do in a market like this? There is, of course, a recession coming. It could be a mild recession. Perhaps the worst is priced in, as a lot of people believe. But what do you do now? Do you still stay cautious on equities? Do you raise your cash levels? Or do you start to nibble into sectors? If yes, which ones are you looking at now?
For equity investors, and especially in a market like India, there are 3 or 4 factors that we consider. Number one, cash generators and companies that have net cash on their balance sheets. We try to avoid leverage as far as possible. When we have a steadily rising interest rate environment, leveraged companies are kind of vulnerable in that environment. Second, we would also rather play value in preference to growth. Now, that particular angle, that particular consideration set is difficult to find in India. It's much easier to find in North Asia, in Korea and China. But as far as possible, even within sectors, we would try to play value rather than growth, because in a rising cost of equity environment, it's the growth stocks or the long duration stocks which would suffer more. Third, we also look at the earnings estimates and in which direction they're moving. If you look at the last 1 or 2 quarters and the quarterly result announcements, there are basically 3 or 4 sectors in India that have seen earnings estimates moving up. Financials is one of them. The second one is industrials, and the third is IT services. We were till recently quite cautious on the IT service companies, but in our most recent rebalancing of the Asian model portfolio, we have actually added to Indian IT service. This was about 3 weeks ago. And we think that the kind of deals that are coming through for the top-rung frontline companies should protect their revenues even in this uncertain environment. So pretty much our Indian silo in the Asian model portfolio is focused on financials, banks predominantly, but to a small extent insurance as well after the recent decline, IT services, and some consumer discretionaries, particularly on autos. Also some of the oil and gas and other energy companies.
All right. Hi, Manishi. Morning. What about the auto stocks? I think you lightened some position the last time we chatted. What's the call out there?
True. We did lighten some positions on the auto environment. Some of the companies, they have moved up quite significantly. And I think it was partly driven by strong fundamentals. If one looks at the order backlogs and the waiting period, for some of the, I wouldn't give it a broad brush characterization, but some subsegments like, let's say, tractors, SUVs, etc., there was a very significant waiting period built in, which obviously led to earnings estimates moving up there as well. But we felt that, after a very strong performance right from late November last year, I think the positives were kind of built in. So the most recent rebalancing that we did was moving slightly away from the auto universe and moving more into IT services as far as India is concerned.
Manishi, I think you sort of put on the table a perennial problem with those who are picking stocks in India. Where's the value, right? So
Right.
There's no easy answer to that question. Where is the value? Beyond IT services, what else are you buying in India?
No, that's a very valid question, and we struggle with it every day. In fact, it was this question primarily that led us to downgrade India to a neutral and upgrade China to an overweight in early December. And we're still sticking to that stance. And I think, despite a small recovery in the FII flows in the month of March, this overvaluation question will continue to play in the minds of the foreign investors who have the entire gamut of emerging market to invest in.
Right,
so it's not an easy question to answer, because I think, across all the sectors, one has to look for relatively cheaper companies, and not only, I would say, cheap, but also those companies which have a strong earnings estimate tailwind. If we are kind of locked into a company which is seeing earnings estimate downgrades, then something that's appearing cheap today might appear expensive tomorrow, and that's kind of a valuation trap that we have to avoid.
Okay, got it. Manishi, thanks a lot for taking the time out and speaking to CNBC TV18. We have to wrap up this conversation, but thanks for leaving us with some ideas. So they like IT services, you're getting into that space. By the way, the market is a bit choppy. A lot of heavyweights are putting a bit of pressure on the market, whether it's Reliance, ICICI Bank, TCS, ITC, all dragging the markets lower. Nifty is down about 28 odd points. But let's get back to some of the big corporate stories that we're tracking. IGL, Indraprastha Gas, was in focus yesterday. The company and Genesis Gas Solutions have entered into a joint venture agreement to set up an integrated smart meter manufacturing plant. Now, this is a deviation from IGL's regular business. They have a capex plan of 110 crores. The plant will be operational by 2024 and will have an installed capacity of 1 million meters annually. To discuss this and the company's diversification plans, we're joined by Sanjay